If you're new to financial statements, this topic is going to be especially valuable. In this opening lesson, we're going to step back and look at the big picture. We'll define what financial statement analysis is, and we'll walk through the role of the major financial statements, along with footnotes and management's discussion and analysis. Let's get started. Publicly listed companies are typically required to prepare financial reports on a regular basis. The purpose of this reporting is to provide useful information about a company's performance, its financial position, and how that position has changed over time. Analysts don't look at financial reports in isolation. Instead, they combine current and past reports with other available information to form expectations about a company's ability to earn profits and generate cash flows in the future. This overall process is known as financial statement analysis, and it plays a key role in investment decisions, credit decisions, and other economic judgments. Financial reports are issued at regular intervals. Depending on regulatory requirements, companies may report quarterly, semi-annually, or annually. A financial report includes the financial statements themselves, along with additional disclosures that help users interpret the numbers. There are three key financial statements you need to be familiar with: the balance sheet, the income statement, and the statement of cash flows. Together, these statements form the foundation of financial analysis. The balance sheet shows the company's financial position at a specific point in time. You can think of it as a snapshot. It is built around three components. Assets represent the resources the company controls, such as cash and equipment. Liabilities are obligations owed to creditors and lenders. Equity reflects the owner's residual interest in the company after liabilities are subtracted from assets. The balance sheet must always balance. Assets are equal to liabilities plus equity. Because the balance sheet captures a single moment, it doesn't explain why the company's position changed from one period to the next. That explanation comes from the other financial statements. One of the most important of these is the income statement, which you may also hear called the profit and loss statement. The income statement summarizes the company's performance over a period of time. At its core, net income is calculated as revenues minus expenses plus other income. Revenues arise from the company's central operations, such as selling goods or providing services. Expenses reflect the costs of running those operations and include things like asset depreciation and liabilities incurred, both of which reduce equity. Other income includes gains that may or may not result from the company's ordinary business activities. Net income explains part of the change in equity for the period. Another portion comes from other comprehensive income. It's important not to confuse other comprehensive income with other income on the income statement. Other comprehensive income includes gains and losses that are excluded from net income, such as unrealized gains or losses on certain investments, foreign currency translation adjustments, and some pension-related items. When you combine net income with other comprehensive income, you get total comprehensive income. Companies may present this information in a single combined statement or in two separate statements. Equity can also change due to transactions with shareholders. For example, when a company pays dividends, equity decreases. Total comprehensive income, together with shareholder transactions, should explain the overall change in equity during the period, assuming there are no minority interests. These changes are summarized in the Statement of Changes in Equity, which shows both the sources and uses of equity over time. Cash is another critical asset for any business. The statement of cash flows explains how the cash balance changes from one reporting date to the next. This statement focuses on where cash comes from and how it is used, helping analysts assess liquidity, solvency, and financial flexibility. Cash flows are grouped into three categories. Operating cash flows relate to the company's normal business activities. Investing cash flows arise from the purchase or sale of long-term assets, such as property, equipment, subsidiaries, or investment assets. Financing cash flows reflect transactions related to raising or repaying capital. When you add operating, investing, and financing cash flows together, you get net cash flow for the period. When this amount is combined with the beginning cash balance, it should reconcile to the ending cash balance reported on the balance sheet. Together, these 4 or 5 statements form the core of a company's financial report. In addition to the statements themselves, financial reports almost always include footnotes. These disclosures are required and are considered an integral part of the financial statements. Footnotes provide additional detail about the numbers presented in the statements and often allow for deeper analysis. They typically explain how the financial statements were prepared, including the fiscal period covered, which entities are consolidated, and the accounting methods, assumptions, and estimates used. Footnotes also disclose other material information that users should be aware of. This may include acquisitions or disposals, legal matters, employee benefits, contingencies and commitments, major customers, related party transactions, and segment information. Public companies also include a section known as Management's Discussion and Analysis, or MD&A. In this section, management discusses issues they believe are important for understanding the company's performance and future prospects. Common topics include the nature of the business, past performance, and expectations going forward. MD&A requirements vary across jurisdictions. In the United States, for example, regulators require management to discuss trends, significant events, and key uncertainties. Management must also address the effects of inflation when material, off-balance sheet obligations, contractual commitments, critical accounting policies that involve significant judgment, and forward-looking expenditures and risks. That brings us to the end of this introductory lesson. Some of these ideas will become much clearer as we move forward, so don't worry if everything hasn't fully clicked yet. In the next topic, we'll turn our attention to audit reports and other important sources of information for analysts. I'll see you there.